It's time for Meet Your Fund Manager segment, and today viewers will meet Axis Bluechip Funds fund manager Shreyash Devalkar, who has been managing this fund since 2016. But Shreyash, welcome to the show. But before I take a question with you, I just want to inform our viewers that you can send us your portfolio queries on our WhatsApp number, which is 865-797-4571, or you can also email us your queries on themoneyshow@etnow.tv. All right, Shreyash, back to you. Welcome to the show, and let's talk about your Axis Bluechip Fund. And let me just start with the fund strategy. Now, this fund follows the growth-oriented approach of investing. And post-pandemic, we have seen that this particular style of investment is out of flavor. The fund had a good run from 2017 to 2020. Now, 2021 has been challenging and the performance continues to be weak. How do you look at it? How do you see this getting corrected now in a few quarters' time?
So, as you have highlighted, and we have been pointing out the philosophy of Axis as a equity house. It has been quality and growth, and we follow it across our funds. So, when it comes to Axis Blue Chip, obviously, it being our large cap oriented strategy, here also the 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 primary objective of this fund is to invest into large cap top 100 stocks with this as a strategy, which is a quality and growth. Now, as you have highlighted that the market post the rally which has happened post COVID or post COVID fall, that is somewhere from the mid of 2020, that rally has been more driven by B2B as a segment compared to B2C as a segment. And in this rally, what we have observed is because of COVID again, there has been issue in growth of consumption-oriented companies compared to a B2B, and that's where the B2B as a segment has outperformed over this period. It's not that in B2C some companies have done well. It's not that all of them have not done well, but I'm just talking about on a relative basis and also on the 3 to 4 year CAGR, just to remove the base effect which is coming out recently. So the strategy of this fund being quality growth and more structural growth rather than a cyclical growth. So this fund has been oriented towards B2C, which includes retail credit growth, because end of the day, the credit growth especially on the retail side is B2B driven. It may be because of housing, it may be because of vehicle or personal loan. While on the other hand, there are segments like retail segment and all. So this fund is oriented towards this as a strategy, and these are the segments which this fund is invested into. So as it is expected that the GDP growth and the consumption growth will come up eventually. Already, if you notice that with this recovery, which has been initially K-shaped, the higher end the discretionary part of economy did well initially, or where the ticket sizes are high. As and when the growth becomes broad-based, the consumption as a pack can do well, and that's how this fund is generally invested into on the B2C side.
Right. But Shreyas, so you spoke about B2C being the focus, but don't you think the story is actually rolling out on a stronger note if we talk about B2C consumption and looking at the entire demand outlook? There are obviously concerns due to global slowdown, but then what specifically in terms of sectors are you looking at in B2C?
So B2C comprise of multiple parts. So actually the largest segment of large caps, which is top 100 companies, has been always financial services. So if you take a Nifty as a benchmark for large caps or the top 50 names, then there also you will notice that financial services is the large portion. And in the financial services also, the growth has been driven by mostly the retail credit part of it. So obviously the credit growth has a corporate credit growth element as well as the retail credit growth. And obviously there is a SME and other segments as well. So retail credit growth, even the pre-COVID level, has been growing at somewhere around mid-teens. And now, after the lull which has happened post-COVID, now it has picked up again, and so that part of segment, which is the retail credit growth, and again it captures everything. It captures the housing segment. The housing segment in top 10 cities of India has been doing really well. So it captures the housing segment growth. It captures the vehicle personal loans. So the multiple part which are on the B2C side, it is captured actually by the retail credit growth and eventually by banks or financial services, which is there. The secondly, on the automobile side, again the four-wheeler part of it, that has done okay in certain segments. So that is one of the segment which is again the consumer driven. The other part are in the retail segment. So what has happened is what I was highlighting initially as well, that the growth in the consumption has not been broad-based. So the penetrated categories, highly penetrated categories, actually, especially in the FMCG, they have not done well, while the categories which are not penetrated or which are catering to the higher ticket size consumption, that have done well. So that's why I highlighted about real estate, which is probably the other one extreme of it, and especially in the top cities of India. On the other hand, again, in case of vehicles, if you just bifurcate the two-wheeler versus four-wheeler, then the four-wheeler growth has been good, and especially again the higher ticket size. So the growth on the B2C side has been mixed. So the segments which are on the higher ticket size, discretionary, have done well, but again, when the growth will be more broad-based, especially on the rural front, in that scenario, you will see a broad-based growth across B2C segment, which includes FMCG as well. And that is one of the reasons why some of these segments like FMCG, where the penetration is high, there the returns of those segments over last 2.5 year has not been as high as some of other segments which I've seen. So when we say B2C, it comprises of multiple sub segments, and most or more based growth may be observed when we see recovery in rural areas as well.
All right. So talking about B2C and the specific sectors that you mentioned, you plan to stick to them because you like these sectors. But then what is the outlook for 2 to 3 quarters? Also, Shreyas, which is that sector where you see a story of catching up, maybe a sector that you want to keep an eye on to look at in the near future?
So when we see the performances, and especially if you look at again everywhere, it's always good to look at the growth from pre-COVID till now, and then compare the growth rather than talking about the growth on the low base of 21 and 22, especially. So we have seen the growth in various categories. So in B2B segment as well, some of the short cycle industrials have done well. On the chemical industry has done well, especially on the B2B side. Apart from that, so the industrial, the chemical, and some of the auto ancillaries have done well. On the other hand, when it comes to B2C, some of these segments were not doing well for some time now. It is not now. So these are the segments, and that's where you will notice that though we talk about market multiples being higher, valuations being high, but on a relative basis, probably the re-rating is has been lesser in these segments like FMCG, some of the financial services. There the re-rating has not happened, and especially because the growth has been relatively weaker on a CAGR basis, 3 to 4 years. So when if you see the growth picking up in those segments, then obviously here the relative re-rating has been lesser in the market. So one need to look at the pockets where the relative re-rating has not happened the way it was seen broad-based in most of the B2B category. And when the growth comes back, so the growth will be combination of nominal GDP growth, so the GDP growth plus inflation, which normally we talk about. So there are certain positives as well as negative of the inflation, but one need to look at those pockets where it will manifest into the top line growth with a relatively subdued impact or relatively lesser impact on margins front.
Uh, Shreyas, let's talk about a few reports on the growth front. Now, so there are reports and economist assessments also that a slight dip in the growth would actually help in easing inflation and help cool down a fiscal deficit too. Does this make sense to you? Are you also anticipating something like that?
So yeah, there are multiple theories going around here, but one fundamental aspect which, as an investor, I would like to focus on is what is the difference this time around when we look at slowdown, when we look at, or everyone when everyone is expecting a slowdown. So the difference is whenever there were crises earlier, may it be GFC crisis or twin deficit 10 years ago, at that time both corporate and individual leverages were higher in the system. So because of that, there were collateral damages in the asset quality, and it had its impact on the financial services sector. So there was a cycle of it, which happened at that point in time. Now, if you take a recent crisis, which is a COVID, during this crisis, actually, you would have noticed that the corporates which were leveraged, they got deleveraged by raising private equity fund or from the equity market. So the point is this time around, the corporate sector is relatively much deleveraged compared to the earlier crisis. Retail sectors is not, or the retail segment is not over leveraged in that sense, and the asset quality of retail also has been better than expected during this crisis. So what it suggests is even if there is a slowdown, last time whenever there was a slowdown, it got further exaggerated because of these collateral effects of slowdown, which has impact on debt servicing, etc. This time around, those negativities or those collateral or those vicious cycle we may not enter into, and that's where even if there is slowdown, it will have its right impact on the inflation, and probably this slowdown may not last for long even if it happens.
But then, Shreyas, let's get back to the portfolio. Although the long-term track record of this fund, say almost about 5 years, is still intact, nothing to worry over there. But then, what about those investors who are actually looking at a dip in their profits in current point in time?
So we tend to believe in our philosophy of quality and growth, and we would stick to it, and we have invested as per it. So it will go through its ups and downs. Our focus is on the companies which we are invested into, whether they are good, whether there is any impact of business models on them. So those things one need to keep on assessing during this time period. And as and when the growth comes back, and as and when the relative growth, so always in the market, the relative growth that matters along with the relative valuation. So there is a cycle to it, both interest rate cycle as well as the earning growth cycle. So both these things would matter when it comes to the returns or return profile of a particular strategy.
Talking about the fund strategy, are you open about changing the fund strategy and the style of investment, or you think looking at the changing scenario, you might take this call, or is it already happening? Will the fund change the style of investing?
So we always look forward to all the investment opportunities across segments. So the fund would be also invested in some of capital goods or some of the capital or the cyclicals, so to say. Probably the commodities as a segment is not there, but most of the cyclicals we are evaluating, we have looked at, and some of them we are already there. So it's not that the fund is only open towards the idea to in the B2C segment. We have been open to all the ideas across industrial, cyclicals, chemicals, and we will evaluate and have a exposure to them if it warrants at a particular price point.
Right. Shreyas, last question to you. Now, the high asset under management, which is almost at 36,000 crore, do you think is a factor impacting the fund performance? Do you agree with this? Because a lot of investors actually think if the fund size is huge, the freedom to a fund manager to make changes gets restricted. Do you agree?
So when it comes to fund size, obviously the fund size with respect to market cap of where it invests, that matters. So like this being a large cap fund and the large cap definition, that is the 100th market cap of 100th stock by the market cap. If you go by that definition, then the lowest market cap where one can invest is still much higher than the size of the fund, because these relative numbers matter rather than the absolutely what is the fund size. So in that context, yes, this fund has is not relatively big compared to the market cap where this fund should potentially invest, especially considering this fund is a large cap category fund in that and which will invest in the top 100 names. Whether it affects the outcome over a longer period of time, generally what you hold and what you keep on holding for long term, that matters. And in that context, if you are buying a stock which are right for a particular cycle, if the fund owns the stock which are right for a particular cycle, then in that context, probably over a longer period of time, in my judgment, the fund size, especially for a large cap category, where the definitions of their market cap are higher than the fund size. So these few aspects I normally take into consideration while making any judgment around this. So in that context, the size uh, may not be issue for a large cap fund.
All right, time to wrap up this conversation. Thank you so much, Shreyash Devalkar, for being on the show and talking about Axis Blue Chip Fund in detail.